Welcome. In this video, Zbcn coin 250% increase can come at once. We will analyze it. Don't forget to subscribe, don't forget to like, and please watch to the end to understand.
Rising trend lines play a significant role in technical analysis as they provide investors with a clear reference point regarding the general direction of a price. These lines are formed by connecting a series of higher lows over a certain time period. This structure indicates that the market is buyer-dominated and that prices are moving in an upward trend. In other words, when the price falls over a given time frame, it stops at a level higher than the previous low and begins to rise again. This is considered a strong sign of an ongoing uptrend. Another critical feature of an uptrend is that when the price reaches this trend line, it often reacts by moving upward. This behavior shows that buyers are still strong and that the price is finding support at this level. In technical analysis, such reactions are described as trend line touches and bounces. These touches are often seen by investors as both entry signals and as a source of confidence. If the price bounces upward from the trend line, it confirms the trend is still valid. Otherwise, if the price breaks this line, it may indicate the trend is weakening or ending. These touches are crucial for investors because they often mark points where the price is likely to continue moving upward. When the price approaches the rising trend line, many investors anticipate a bounce from that line. With this expectation, buy orders increase and the price rises again due to this demand. That's why a price bounce from a rising trend line is not merely a coincidence. It reflects both market psychology and technical analysis principles. This phenomenon is also closely related to the support-resistance mechanism in technical analysis. Rising trend lines are considered dynamic support levels. Instead of a static horizontal line, they represent a support level that moves upward over time. When the price reaches this line and market conditions are favorable, it tends to pause, gather strength, and resume its upward movement. These dynamic supports offer investors more flexible analysis, since market conditions evolve and support levels move accordingly. Moreover, the strength of a rising trend line is measured by how many times it has been tested and how the price has reacted after each test. If the price has touched this trend line multiple times and bounced upward each time, the trend line becomes a strong and reliable structure. A break of this line is then seen as a much more serious signal, as investor expectations may shift at that point. However, if the price continues to bounce and rise from the trend line, it indicates that the bullish structure in the market remains solid. When the price finds support at a rising trend and bounces upward, it also reveals that buyers see this level as an appropriate entry point. Investors often prefer to buy at such trend supports, placing stop-loss orders just below the trend line to minimize potential losses in case of a breakdown. This behavior increases buying volume as the price nears the trend line, which helps the price reverse direction and rise again. Prices that bounce from a rising trend line also tend to have the potential to create new highs. Support at this level increases upward momentum and provides the energy needed to surpass previous high levels. This can trigger the next leg up in the price movement. In particular, such reactions from support zones increase investor confidence in the market, which in turn pushes prices even higher. Therefore, the bounce from a rising trend is not just a technical formation, but a reflection of overall market psychology. Furthermore, this structure is not only significant in smaller timeframes, but also in medium and long-term charts. Rising trend lines formed on daily, weekly, or monthly charts provide much stronger signals. The reactions to these lines can affect not just short-term price action, but also macro trends. As a result, these support lines are highly valuable for long-term investors. A bounce from such lines is a key factor in deciding whether to hold on to or open new long-term positions. Additionally, these trend lines are used not only manually, but also as reference points in many algorithmic trading systems. If the price bounces in line with historical data, such algorithms may trigger new buy orders, which contributes to the price finding support and strengthens the continuation of the trend. In this way, both manual traders and automated systems consider these trend supports and shape their positions accordingly. In conclusion, when the price touches a rising trend line and finds support there, bouncing back upward, it is interpreted as a highly positive development in technical analysis. This structure aligns with both historical data and investor psychology. These bounces show that buyers are still active and that the trend remains strong. If this movement is supported by volume, meaning the price bounces with high trading volume, it signals that the upward move will be more decisive and stronger. For this reason, investors should closely monitor these trendline touches as they are crucial for making strategic decisions. A bounce from a rising trend is among the most reliable and promising technical patterns for the continuation of a bull market. But we can't make decisions based on trends solely, so let's take a look at the other metrics too. Stay tuned.
The RSI, Relative Strength Index indicator, is a powerful tool in technical analysis that provides investors with highly valuable insights. This indicator measures the speed and change of price movements over a specific period, helping to identify overbought or oversold conditions in the market. It typically moves between 0 and 100, with levels below 30 considered oversold and levels above 70 viewed as overbought. However, RSI is not limited to just these two levels. When combined with ascending or descending trend lines, it can generate much more effective signals. Such trend formations on the RSI can offer investors deeper insight into the direction of price movement. At this point, ascending trend lines forming on the RSI become highly valuable structures in technical analysis. In the current technical setup, a clearly upward trend has formed on the RSI. The RSI has been steadily making higher lows over time, drawing the framework of an ascending trend. This structure indicates that upward momentum in the market continues and that buyers are entering the market with increasing strength. As price fluctuates, the RSI forming higher lows in this manner confirms the confidence of market participants and signals that the price is in a healthy upward trend. At present, the RSI is approaching this ascending trend line closely, and it is expected to act as a support. This paints a very positive picture from a technical analysis perspective. Ascending trend lines often serve as a springboard for the RSI or price to start moving upward again. If the RSI bounces off this trend line, it would signal that upward momentum in the market remains intact and that buyers are still dominant. Such a scenario would be a strong signal for the continuation of the upward movement in price as well. At this point, a bounce from the RSI's trend line does not merely mean an increase in RSI, it also suggests that the price may gain momentum and begin another upward move. In technical analysis, reactions from RSI trend lines are often precursors to price movements. Therefore, whether the RSI bounces from this trend line will provide critical information about the future direction of price. In such situations, investors often base their positions on the RSI's reaction to the trend line. If a bounce occurs, it is seen as a buying opportunity, laying the groundwork for a new upward wave. Additionally, the RSI moving along an ascending trend line and finding support from it sends the message that price movements are healthy and sustainable. As long as the RSI continues to reflect strengthening momentum, price is also expected to rise steadily. In this context, a bounce from the RSI without breaking its current upward trend would be a highly critical development. This is not only important in the short term, but also essential for the continuation of medium and long-term uptrends. Preserving this ascending trend structure in the RSI clearly indicates that the market remains strong and that buying pressure continues. The RSI staying above this trend line suggests that corrections or pullbacks in the market may be limited and that the primary direction is still upward. In such a case, price breaking to the upside and surpassing resistance levels becomes highly likely. Therefore, the reaction of the RSI at this trend line is not just a technical detail, but also represents a psychological threshold. Another crucial point investors should pay attention to is that a potential bounce from the RSI trend line may not be just a one-off jump, but rather a sign of a larger upward move. The RSI remaining consistently above an ascending trend line strengthens belief in the market's upward trend. This belief positively influences investor behavior and encourages new buyers to enter the market. As a result, prices begin to gain upward momentum. A bounce in RSI from such a trend line can trigger this positive psychological shift among investors. A renewed upward move in the RSI after finding support from the ascending trend line may also align with signals from other indicators used in technical analysis. For example, if price approaches a support level and forms a base, and the RSI bounces from its trend line at the same time, it creates a dual confirmation mechanism. Such simultaneous confirmations from technical structures offer highly reliable signals for investors looking to open positions. Professional investors, in particular, place significant importance on such multiple confirmations when making decisions. The preservation of this ascending trend in the RSI and a bounce to the upside should be considered an extremely positive development in technical terms. It should not be seen merely as a short-term jump, but rather as a strong indication that the trend continues. As long as the ascending trend line is not broken and the RSI forms higher lows, it points to a healthy upward movement in price. In this case, investors may choose to hold their positions or enter new ones to participate in the upward trend. The adherence of a momentum-based indicator like RSI to its trend line offers a high success rate in predicting the direction of price movement. Therefore, it is crucial for investors to be aware of such structures in the RSI and incorporate them into their analysis. A bounce from the RSI's ascending trend line signals that the market is still strong and that pullbacks are simply healthy breathing phases. In such times, avoiding panic selling and taking positions in the direction of the trend can yield gains for investors in the long run. Finally, the preservation of this ascending trend in the RSI and a bounce from it should be interpreted as a very positive signal indicating that the uptrend in the market may continue. In such a scenario, both price movements and investor psychology are positively affected, which accelerates the market's upward momentum. Therefore, the RSI's potential bounce from its current trend line is a critical technical development that investors should closely monitor. As long as this structure is maintained, it is highly likely that the upward trend in the market will continue and new highs will be reached.
The Elliott wave theory is an analytical method that expresses investor psychology and collective behavior in financial markets through recurring wave patterns. According to this theory, market movements begin with a 5-wave impulse move followed by a 3-wave correction. Within this framework, when we examine the current wave structure, it appears that the asset in question is moving within the 3rd wave. In Elliott theory, the 3rd wave is typically the strongest, longest, and most voluminous upward movement. Therefore, the 3rd wave represents the most profitable positions for investors and is the phase where prices rise dramatically. By nature, the 3rd wave can never be the shortest and is usually longer than the 1st wave. To determine the target of the 3rd wave, Fibonacci extension levels are commonly used in technical analysis. Among these, the most widely followed level is the 1.618 extension. However, at times, this level can reach much higher values. In some strong bull markets, the 3rd wave has been observed to extend to the 2.272 Fibonacci level. Reaching this level indicates a dominant sense of optimism among investors and a peak in buying enthusiasm. At present, the asset being analyzed continues to move within the 3rd wave, and there is potential for the price to reach the 2.272 Fibonacci extension level. Compared to the current price, this level implies an increase of approximately 250%. In other words, if the investor holds their position until this level is reached, there is a possibility of the investment increasing by up to 3.5 times. This is an exciting development, not only from a technical analysis standpoint, but also in terms of investor psychology. During the 3rd wave, the flow of positive news increases, FOMO, fear of missing out, becomes widespread, and many new investors enter the market. The price surges observed during the 3rd wave often captivate investors and create the perception that the market will rise endlessly. This perception brings in more participation and further price increases. However, there is a crucial point to keep in mind. Although the 3rd wave is the strongest upward movement, it does not last forever. Therefore, investors must avoid letting emotions take over and instead build strategies based on technical analysis data. If the price reaches the 2.272 Fibonacci level, and this level coincides with a previous resistance zone, it can be a highly strategic area for profit-taking. This is because the 3rd wave may end at this point, followed by the beginning of the 4th corrective wave. The 4th wave is typically a complex and sideways correction and requires patience from investors. For this reason, as the end of the 3rd wave approaches, it is essential to reassess positions and activate risk management measures. Another important consideration is that for the 3rd wave to have such high potential, it must also be supported by structural and fundamental factors. In other words, relying solely on technical indicators is not enough. Project developments, overall market trends, macroeconomic data, and news flow must also be taken into account. Major price movements generally arise not just from chart patterns, but from real-world events. Especially in the cryptocurrency market, events like major exchange listings, strategic partnerships, regulatory developments, or technological upgrades can trigger such rallies. Another key technical detail is that there can be occasional pullbacks during the 3rd wave. These pullbacks should not cause investors to panic, as corrections within the 3rd wave are usually short-lived and followed by new highs. Therefore, investors who are prepared for short-term volatility and who keep their focus on the bigger picture are more likely to take full advantage of the opportunities presented by the 3rd wave.
In conclusion, in a scenario where the price is currently in the third Elliott wave and targeting the 2.272 Fibonacci level, the 250% upside potential presents a major opportunity for investors. The realization of this potential depends not only on technical indicators, but also on investor sentiment, rising volume, fundamental developments, and market perception. If all these factors align and the price reaches this level, it will mark not only a technical success, but also a strategic investment victory. Investors who have maintained proper risk management up to this point will not only achieve significant gains, but also experience firsthand how effective the Elliott wave theory can be in practice.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.